Good day, everyone. Thanks for attending, and thanks to Dumanu for such an amazing event and such a lovely welcome. Today we're going to be speaking, as mentioned, about ETPs. We're going to be speaking about RWA and the tokenization journey that's currently going on, and then we'll kind of maybe talk roughly around the kind of technology and how it interacts with the financial system. I will say, in terms of my bucket list of desires, following the previous panel with two Goliaths of the industry, probably wasn't at the top of my list, but we'll try and do what we can do. So just to introduce myself, I work for Archax. Archax Group, UK and EU regulated firm, custodian, broker-dealer, exchange, and I operate the ETP business and the tokenization business and supporting stablecoin issuers. Going now to our distinguished panel, if each of you could introduce yourself, your company, and maybe speak briefly about your journey into this industry.
Thanks, Keith. My name's Alex Kim. I'm from Blokdemonn. Blokdemonn is a blockchain infrastructure company. We offer trifecta of products and services, including staking, node services, and API, plus wallet products and services using our MPC technology. We're obviously a startup founded in 2017. Seems like ages ago. Raised $400 million plus $1 million in funding. And we're operating globally, worldwide, with about 6 physical offices, but most of us actually work remotely in a distributed way, just like blockchain. My journey into the space is kind of serendipitous and fortuitous, I guess, in some ways. I've always been in the networking business, including cellular, Wi-Fi, IP networking, Ethernet networking, IoT even. And then I was looking for something else to do and found cryptography as the next thing. And I was working for a small startup focused on MPC, multi-party computation, really just to encrypt and decrypt data and using key management technologies that we had developed using MPC. And blockchain, especially with the crypto, you need to protect your private key. And that's where we found our use case. And 2 years later, we were bought by Blokdemonn. That's how we joined the company. And we're pretty happy to be here. Thank you.
Excellent. Well, wonderful to be here. It's my first time, actually, in Seoul. I first came last year for Korean Blockchain Week and already been here 4 times, so you have a wonderful community. Excited to be here again. My name is Giorgos Vlachos. I'm co-founder of the Axelar network. Our thesis has always been that there's going to be multiple blockchains. There's already hundreds of important blockchains. If we look at the permissionless Web3 space, I really like how Michael framed it earlier about the importance of artificial intelligence agents in our life and how every individual will have their own AI, making decisions for them and simplifying their life. Well, in a world with artificial intelligence agents, there's going to be so much data that has to go through the blockchains, because as Michael very eloquently articulated, we can't expect AI agents to interact with TradeFi and those very complex and obscure systems. We need a new paradigm. And on-chain is that new paradigm. And in such a world, there's going to be so much data on-chain that no single chain is going to process everything, right? So potentially, we may see a future with even millions of chains. And in such a world, we have fragmentation, right? So how does an AI agent or a user that holds funds on one chain use an application on another chain or even pay someone on a different chain? And this is really the problem of interoperability that Axelar is solving. How do we simplify user experience and we solve for the fragmentation in a world with thousands or millions of chains? And a few words about my journey in the space. Alex, I actually found out that we both went to MIT for our undergraduate studies. I am from Greece originally, a country where very recently we had capital controls and people could not access their funds in the bank. And when I was at MIT, my advisor, Silvio Micali, introduced blockchain to me. And back in the day, that was like 2015, 2016, Ethereum was just starting out, only Bitcoin existed. we started looking into building a more efficient technology in proof of stake. So while at MIT and for a few years after, I was part of the founding team of the Algorand blockchain, where we designed and built one of the first proof of stake networks in the space. And once we launched it, me and my co-founder left Algorand to start Acceler, and fast forward to today, we're here and very excited to be here with you all.
My name is Justin Kim. I'm head of Asia for RWA, and RWA is a company that supports ecosystem on Avalanche Network. And Avalanche Network is really a partner-driven platform, and we basically help our teams, partners, institutions, financial institutions, really improve their business or fix problems with blockchain. And on Avalanche, so it's basically a multi-chain network, and each L1 by our partner is actually adaptable, is purpose-built, and primed to deliver real value across industries in whichever business they are in, whether it's gaming, whether it's finance, and whether it's K-pop or any other topics. And my journey into a blockchain, I actually spent 13, 14 years in traditional banking with the dream of, because I believed in the power of finance, empowering people and businesses. And one day I saw more opportunities in blockchain doing that, because blockchain is basically a tool to empower people, finance, also ideas. So that's how I got into the blockchain, and thanks for having us.
Very good. Thank you very much. So if we focus on the first topic, I've been here for a few days. I've done a lot of meetings. It was my first time in Korea, and I'm just blown away by the energy level and just the sheer intellect of the people that I speak to. And if I rank the 3 points that keep recurring, is at the top is real world asset, STO, then comes AI, and then comes ETP or ETFs. So I think it frames our conversation quite well, and hopefully the audience will get some good information from us. So talking about the ETF journey, like our own experience is that it really started in Europe. It then moved to the US, to Hong Kong. You see some in Australia. So the ETF/ETP structure for crypto is when we deal with protocols and when we discuss why they want to seed or why they want to create ETFs and ETPs, especially the smaller layer ones and layer twos. It's down towards giving new types of investors who want an abstracted way to access exposure to the token. That's a kind of one of the primary reasons. In the conversations with people in meetings is that there's a great expectation now that in Korea, probably in 2025, that the Bitcoin ETP or ETF will be permitted. So I don't know. Do you have any kind of thoughts on ETFs and ETPs that you want to share?
Sure. We're a blockchain infrastructure company, so we help these ETP or ETF issuers in preparing for the actual issuance of ETF products out in the market. In U.S. as well as Hong Kong, and some of the experiences we've had working with European partners such as 21 Shares or CoinShares, we've learned that they don't necessarily just work in silos. They have to work together. TradFi, meaning the banks, have to work with more crypto-native institutions in order to actually make the products work seamlessly. We found that obviously in U.S., BlackRock is the Goliath. Certainly they've done very well with their Bitcoin ETF. They issued only 11 months ago, and it's just skyrocketed. I actually read in the Wall Street Journal this morning that the overall ETF market is now about $94 billion, and BlackRock itself has about $42 billion under management. So it is huge just for Bitcoin, obviously, and there's other ETFs such as Ethereum. But what we've seen is that TradFis have to work with crypto natives because of the fact that they're not necessarily equipped with the ability to custody their digital assets yet. They also don't understand exactly at this point how all these wallet addresses and all these things actually work seamlessly. So I think there's some, initially for now, they're going to have to work in tandem. But eventually, I'm sure there are going to be ways to bring some of the skill sets into their own houses and figure out a way to offer their services and products to their customers within their own abilities. So I think that's what we've been seeing, that we've seen a lot of interest. I mean, to just give you a little example, Blokdemon's works with top US banks, about 4 out of top 10 banks in US who are in the crypto business especially, are our customers. And also about 85% of top 20 crypto native custodians and exchanges are our customers around the world. So what we see is that they all have to work together. And we've seen that in Hong Kong, where it's always not just the exchanges or VATPs, as they call them there, working with actual issuers. So the TradFi rails are there. So they work with government regulators. They work with their customer base. And so they can issue ETFs very well. At the same time, they have to work with the actual crypto native exchanges and custodians to make sure that assets are secure.
Okay. Just again, from my own assessment of these meetings and where South Korea stands is that it's probably the most sophisticated market I've ever come across in terms of individuals' understanding of crypto. So I think the addition of a Bitcoin ETF for Korean investors, especially institutions, would be very additive, to the ecosystem here. I think probably I'm just mindful of the time is getting short, So if we move on now to real world assets, It's come out of nowhere. It's been moving, like we were aware that it was coming, but it's been moving very slowly because of regulatory barriers and difficulties, and getting the right people in the same room to make it work together. But maybe if someone could take a question about, to describe tokenization relative to real-world assets, maybe to the audience, and why it's important, and maybe juxtaposition it against what we have currently in terms of how these assets are offered. Maybe Alex. Sorry.
Yeah, I can just start with where we are in terms of tokenizing financial assets. I think in terms of the digital asset space development, I think we're at phase 4. I think the first phase was ICO, where we actually saw and experienced the potential of capital formation at the global level, meaning that you can basically raise capital from anyone around the globe. And then I think the next phase, then we moved on to maybe, since we have this capital formation capabilities, maybe we can just tokenize a lot of things, right? So I think at some point we were tokenizing unattractive assets. But we also learned that in that process that tokenization doesn't invite liquidity, and tokenization doesn't make unattractive assets attractive all of a sudden. So, and then I think the next phase, like phase 3 of this digital asset development, was that maybe then we can bring in the best asset managers in the space, and maybe we can tokenize existing financial products and serve the traditional investors. That's when BlackRock, KKR, JP Morgan, Wellington, they all came in, and a few of the funds were actually tokenized on Avalanche. And yes, we did have some success until BlackRock's BUIDL. Before that, I think we raised about $50 to $100 million of investment for these funds, very traditional private equity funds. So that is success, right? 50 to 100 million, that's not a small number, but we're in the business of trillions of dollars of markets. So that, while that was still a success, I think we're now at a phase, because throughout these processes, we saw a new market, because if you check the numbers today, there are about $180 billion of stable coins. And I think that's a really good example of tokenization. And I think tokenization, the market grew because I think we love crypto, we love investing in digital assets, but then at the same time, it's risky. These are risky assets, and so people are diversifying their portfolios now. So they want to park some allocation of their portfolio into a very stable and safe assets. So that's why we see $180 billion of stable coins sitting there. So I think right now, phase 4 is time to cater and serve the wealth and users in more crypto-native side of things. So that's what we're seeing actually the growth in money market funds, which is a very safe asset, but you can still earn very safe yields. Treasury T-bills, tokenized treasuries, their market actually doubled in the last 6 months. So I think we're at a phase 4 of this process development that it's time to cater to the users and wealth in crypto space.
Super, George.
Yeah, I mean, completely agree with Justin, and things are finally moving fast, right? I remember 7 years ago when I was at Algorand, we were trying to, engage governments, institutions around CBDCs. Everything was moving so slow. And the first wave of tokenization, well, I guess even Bitcoin in a way, was the first tokenized asset. Took a few years, we saw the rise of stablecoins, and just a year ago, we had no tokenized treasury yield products on chain, right? Which is like a very, very simple product. And a year later, we already have more than 10 of them. BlackRock, the biggest money manager in the world, tokenizing on public blockchains. And I can probably name 10 of those products off the top of my head, even though there was nothing last year. And as Justin, you talked about the different waves of tokenization, really the goal of crypto and blockchain has always been accessibility. How can we make every asset in the world frictionlessly accessible to every human being, right? So while right now we're making incremental steps, first with stable coins, next with tokenized treasury bills and other yield-bearing products, in the near future we're going to see assets like art pieces and collectibles and even real estate being tokenized so that you can do very interesting things on-chain. And it's not just about accessibility, it's also about cost. Because for institutions, if you want to be able to process a loan, there's many people involved, it's a cumbersome process, it takes time. So with blockchain, by putting an asset on chain, you should be able to issue loans for arbitrarily small amounts of assets, right? And even enforce how this loan will be used so that you can offer better rates to customers, right? Because you know that if someone takes a loan on chain, you can even enforce contractually that they're not going to go and gamble it on some casino or some meme coin, but they're going to use it for a specific purpose, right? Which de-risks the institution. So tokenization is about accessibility, but it's also about reducing costs for institutions and making all of their operations today much, much easier.
Okay. You kind of half answered my next question, which is, should institutions care about this? Should it just wait on the sidelines and let us run around for a while? And so maybe back to you. Do you think institutions is this a Kodak moment, for the existing institutions that run, especially in the TradFi world? Should they be looking at what's happening here?
Yeah, I think one reason that was just discussed was streamlining their operations so they can make a lot of money and save a lot of money in doing so. If we zoom out, I'd like to look at those things from the perspective of an emerging technology, right? And this has repeated so many times in the history of the world, especially in the last 100 years. But the best technology always wins on a long enough time frame, right? So as a player who has to make a decision whether to adopt that technology or not, you can either stay on the sidelines and wait for others to adopt the technology first, and then maybe you catch up, or you can just jump on the wave and try to be an innovator, right? And generally what we see is that innovators are the ones that succeed, and everyone else who waits on the sidelines, it's just too hard to catch up later down the line, and you get disrupted, right? So if you're an institution, I feel like we're at a very critical point in the growth of the blockchain industry where many legitimate players are adopting the technology. So if you don't want to fall behind, you should just adopt the technology, right? And make sure you're part of this new wave. And it will also save you a lot of money and a lot of headaches in the process, right? So there's so many reasons for institutions to adopt the technology today.
You know, I agree with Georgios. I think it's obviously interesting that the irony is that we're taking RWA, which is really just taking real world assets today, meaning existing or more traditional assets, and putting it on the blockchain. And ETF is just the opposite, right? Where you're taking crypto native assets and then putting it on the traditional rail, meaning that basically offering it to the clients that you already have that are already used to having traded ETFs on traditional exchanges and whatnot. So I think at some point, I think there's going to be a mix of the two. There's going to be best practices coming from both of those, and I'm sure we won't be talking about ETF versus RWA per se. It might be just a combination of both that are going to be offered as financial products to the customers.
Okay.
Can I just add one thing?
Please.
Yeah, so in terms of whether institutions have to come in, so I want to talk about the money market fund. So Franklin Templeton, their Benji token is actually a tokenized money market fund. They just expanded onto Avalanche too. And we recently had a conversation, and there's a requirement for transfer agent in the United States. So basically, you have to keep real-time track record of where the fund is, where the fund belongs to. So at Franklin Templeton, they have this TA team, transfer agent teams at their office. For their traditional money market fund, they have 50 people. Do you know how many people they have for Benji team? Just one. Cool. So I think that's just one example that these institutions will need to step in for saving time, saving cost, and I think that's just one major reason and example. Yeah.
Okay. I do take the rule of thumb that if BlackRock move on something, if you're an asset manager, you've got to be moving as well, or you're dead. So, and they did something very special. They came in from a TradFi perspective into crypto, and then from a crypto perspective into TradFi. It was very impressive what they did. And then speaking about institutions, why should they Kodak moments and that? I can just give a kind of a practical example. Was it we as a firm, we've signed kind of tokenization agreement with a large fund administrator for their several thousand clients, and then by coincidence another fund administrator contacted us because they were getting pressure from their clients saying, why aren't you doing anything in tokenization? So now they're running to catch up. So as an institution, depending on which part of the capital markets you exist, I think being educated about this is extremely important. Whether you actually execute or not is another question, But so that's that. In terms of one thing we find as well is that we're all TradFi, we're all ex-hedge fund people, so we're coming from that side, and but when we talk to institutions who especially don't have experience in this, and you go through the education of what all of this is there anything that you would recommend to an institution that isn't necessarily experienced in this area when they're trying to select partners, infrastructure partners within crypto and within blockchain? Is there anything that they should be looking at? Is it just basic due diligence?
I think one good way to actually, I would suggest for these institutions, is try proof of concept models. So just in Singapore, we actually work with the Singaporean government, with JP Morgan. We all actually worked with XL last year. What we did was actually making private alternative assets available and transferable between chains. But it was still a proof of concept. So I think in some countries, POC is dismissed as worthless, like it's waste of time. But then when you actually go through an extensive POC process, almost commercial ready, you actually learn a lot of things and gain confidence. So I think just based on our project Guardian with MAS, XLR, JP Morgan, Citi last year, I think that's one way I would definitely recommend for institutions to just try stuff, because you don't have to start and selling and tokenize all of your funds just from day one, right?
Okay.
So from the industry, I think we're doing similar things to make sure that we don't have that crypto, I wouldn't say garbage, but the reputation hasn't been great. So some of the things that we're doing at Blockdemon, for example, is that we have this new initiative with several other partners that are reputable. For example, Coinbase, Figment, and others, Liquid Collective, for example. We formed a consortium initiative that focuses on standardization of node operation. So we call it NORS, or Node Operating Risk Standard, where we're trying to reduce risk in terms of slashing risk or diversity risk of your validators, for example, when you're actually running node validators for proof of stake. Those are the efforts that we're trying to make sure that the industry knows that you're working with institutionally focused partners, and I think that's one step in the right direction. And some of the customers we work with us because we, for example, when we do staking services, we only work with OFAC compliant, blocks, for example.
Okay, super. Sorry, George.
Okay, very briefly.
Yeah.
I think proof of concepts are great. We did this work last year at Project Guardian with Avalanche. But one advice from my side to financial institutions is look at products that have been successful in the native Web3 space,
yes.
right? Because that's where your technology gets battle tested. Today, arguably, Avalanche is the most widely adopted blockchain from an institutional perspective, but it wasn't always that case, right? They've been building for about 6-7 years. At this point, the stack got very widely adopted in the decentralized Web3 space, and it's very important that the technology is battle tested. A lot of developers built on top of it, improved it, right? So I don't expect some institutional companies coming and building their own blockchains from scratch, but they should adopt the technology that's already been battle tested and has been live for 5 to 10 years already.
Okay, very good. Then looking at, I would say, current examples of things that have been starting to go successfully, like money market funds is an example. Obviously, Archax, with Hedera have been working on, BlackRock and Aberdeen and Fidelity and other money market funds, But outside money market funds, is there anything else going on that maybe institutions might be interested in? Is there any kind of real-world examples that are in the pipe that you think that might be exciting for them?
I mean, we can just talk a little bit more of our work with JP Morgan last year. So they were trying to fix a problem in the asset management space, because traditionally in asset management, your universe of investable assets are limited to assets that are electronically available, meaning that only stocks, maybe ETFs. You never had access to private interests of your favorite VC fund or real estate funds. So JP Morgan actually wanted to fix that problem, and XLR, Avalanche, we got together, made all these traditionally inaccessible private assets. They became tokens on Avalanche network, and they were transferred to JP Morgan's Onyx blockchain asset management platform. So I'm seeing a lot of opportunities in the asset management space for high net worth individuals, institutions, and family offices as well.
Okay, yeah, very good. Yeah, just not to push Archax, but just in terms of kind of a real-world example that we're doing with some of the largest custodians, some of the largest asset managers, is creating a collateral network using initially money market funds, to work together. It's POC by concept, obviously, but what we sense is that global firms now are really in on this. It's they understand the need for it. They understand the cost savings that you mentioned, which can be astronomical. But also the I would say the enablement that it allows. So once you take an asset and then you tokenize that asset, that token can do stuff. There's all of these smart people next to me that can take that token that then can move between protocols. It can move between geographies. It can be programmed, for regulatory issues and all of that. So so that's a kind of a use case that we've seen. Just in relation to the POC, from our perspective, we did a lot of POCs and they're fine, but what we've tried to do now, just because of time constraints and that, is that we do try and fix the secondary trading issue before we start. So we generally have to get either a market maker or a secondary player or some distribution to work with us in that, you know. So we have a lot of kind of interesting commodity plays and voluntary carbon and things like that going on, you know. But we've like if you can design a project where at least you get partial success at the end, you know, like a lot of feedback I got from meetings was, okay, STOs are great, but where's the secondary liquidity? And you have to give the answer, which is you have to create it within the project yourself. And the other thing is that you have to have this interconnectivity between the incumbents, you know, the Upbits of the world, you know, the Coinbases of the world. You know, we need to work together to grow this. You know, it's slightly different from the hedge fund world where you kind of stabbed each other in the face. You know, but in this we need to grow the pie, and you know, I think the work that you guys are doing is really getting us that direction. You know, so. Then if we then look at like the previous panel mentioned, you know, the change of government in the US, you know, for me personally, I think this is quite dramatic, you know, and it's dramatic from the perspective of, you know, a few of us have dealt with regulators and, you know, the kind of the distrust of crypto, the distrust of blockchain, you know. I do feel that, you know, if the new administration deliver, it will put pressure on London, it will put pressure on Europe, it will definitely put pressure on South Korea to start moving on, you know, which is only a positive. Like, do you take a similar view to that, or please, Sergio?
Yeah, I'm personally very optimistic, or maybe say cautiously optimistic. You can never be too optimistic with politics, but. The main reason why we've had such a hard time to see any clear regulatory guidance, especially in the US, is because the regulators just don't use the technology. Right? We have people that are very smart, right? They're very, very capable in their fields of expertise, but the vast majority of them have never installed the blockchain wallet. They don't even understand how the technology works, right? It's similar to, like, you know, someone on this panel like being advised on how to regulate the medical profession, right? Like, we're all very smart people, but we don't have the expertise there. So with the new administration and President Trump, he has shown appetite to place experts in different industries in critical roles, which to me has been the key missing piece, right? So if we place people who understand the technology, care about it, and use it on a day-to-day basis, they will be able to make much more informed decisions about regulation, and hopefully we can finally get some clarity, right? And, you know, we don't have to worry about everything we do in the space.
Okay, fine. Just one thing I would note as well is that every firm that I've met with in Korea has something in the pipe on STOs. You know, they've a sandbox, or they're looking at it. You know, so I think it'll be very interesting to see people come out of the blocks in 2025. Just we'll take one question just before we finish, very fast one. Asset tokenization is offering various new investment opportunities. Which is the asset class that with the most promising potential for tokenization? Do you have any quick answer on that? You know, like an example would be real estate, bonds, private credit. You know, like the things that we see are there. You know, I think, you know, from a hedge fund perspective, if I look at, you know, the CDS market, if I look at the RMBS market, the CMBS market, all of those are controlled by a small group of trading desks, primarily in the US, and they're essentially contracts that are made for a smart contract. You know, I do think, you know, and these markets are, you know, 18 trillion of notional capitalization. You know, so I think those assets will be great, but in the short term, it will be commodities, you know, real estate, things like that. So I think.
Yeah, outside of the real estate and bonds, the traditional investment tools, I think K-pop, animation, or luxury watches, they have been a great asset and have shown quite a big returns as an asset, and it's really easy to tokenize them. So we're seeing K-pop production coming onto blockchain in Korea and in Japan. The Mizuho Securities, they have recently tokenized a fund just to support anime production. So those are new kinds of assets, usually tied to personal interests.
Yeah. Okay, very good. We'll wrap it up now. You know, but again, thanks to Dynamo for the really amazing conference and such hospitality, and you know, thanks for everybody for listening. So have a great day. Thank you.